With inventory up 41% and nearly 40% of the homes on the market having price cuts, the housing market is changing fast. And on top of that, if we add in surprising demand for new homes and potential Fed rate cuts, you've got a recipe for major shifts ahead in the 2024 housing market. So what does all of this mean for you? Well, that's exactly what we're going to break down in today's video. It's been a little while since I've done one of these videos where I've talked about all the changes that are happening in the housing market. But if I'm being completely honest, these changes are actually changing my perspective on the direction of the housing market, and that's exactly what I want to talk about in today's video. My name is Jeb Smith, and I've been an agent for over 20 years. My channel is all about helping buyers and sellers navigate the crazy real estate world. So if you're just finding me and you find any value in this content at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything real estate related, do me a favor and consider subscribing to the channel. As you've probably heard me say in many videos over the last couple of years, everything comes back to supply and demand. That's essentially what drives the housing market. And at the moment, we have nearly 700,000 unsold single-family homes sitting on the market at the moment, which is 41% higher than where we set this same point last year. And the primary reason for that has just been housing affordability. Housing affordability has been sitting at some of the worst levels ever recorded on record for the last couple of years. And it's due to home prices continuing to increase while interest rates went from the mid 2% range as high as 8.1% last November. But since then, we've actually had mortgage rates pull back considerably, which is why home sales actually rose in July for the first time in 5 months, which was coupled with a surprise lift in new home sales in July. And this is primarily due to interest rates coming down, housing affordability improving, giving buyers that extra little nudge, whatever they needed in order to come to the housing market. But here's the thing, it's not all rosy out there when it comes to the housing market. Nearly 40% of the homes at the moment have had some sort of price cut, which is considerably higher than where we were, say, back in March of 2022, when we were under 20% of the homes on the market having some sort of price cut. And the key difference in that time and this time was that interest rates were considerably lower, in addition to demand being way higher than supply. So we had more people wanting to buy homes, less available inventory out there for them to purchase, and housing affordability was at better levels because mortgage rates were lower. And that's exactly why the housing market is slowing down, because we have more inventory coming to the market. We have less buyer demand out there able to buy these homes. You've often heard me talk about the willing and the able. Everybody is willing to own a home. Everybody wants to own a home, but only so many people are actually able to pull the trigger, able and ready to pull the trigger. And on top of that, add in seasonality. We're at the time of the year when the housing market naturally starts to slow down. This is when the kids start to go back to school. Families get back from vacation. They're not ready to start moving their kids into a new school district. That's why they like to get it done before the school year starts. So when you go back and look historically at the ebbs and flows of the market, this is naturally the time when things start to slow down. And once you add in that additional supply and those homes that are sitting on the market not selling, in turn, you get a recipe for a shifting housing market. But with that, it's important to understand real estate is local. So depending on where you're located in the country, you might be affected more by this increase in inventory than other parts of the country. Here where I'm located in Orange County, our inventory is up about 30% higher than this same point last year. But it's important to understand that we're actually 93% lower than the 3-year average leading up to the pandemic. So yes, inventory has increased year over year, but it's always important to understand the baseline. Where are you actually increasing from? So with that, my market here is still moving along. Yes, there are some homes sitting on the market longer. Yes, there are some homes taking price cuts, but at the same time, there are some homes selling in a weekend, selling in just a couple of days, and selling over the asking price. So it's important to understand the market that you're in, and don't just take a broad headline and apply it to your market. Find someone in your market that understands the data, because that's actually going to have a bigger impact on the home buying process than anything that I'm talking about here. But with that, Zillow just came out with their forecast, and they're expecting an increase of about 1% year over year. Now, when I say that, I'm talking about the majority of the United States, as well as the 5 metros expected with the slowest forecasted price growth. And when it comes to cities where they are expecting expecting the highest price growth, a large majority of those cities are actually located in the Northeast, where the market is still hot, where properties are still selling very quickly, where inventory is low, demand is high. Areas like New Haven, Connecticut, as well as Hartford, Connecticut, Syracuse, New York, which they're expecting somewhere in the 3% range. On top of the list, they're actually expecting Knoxville, Tennessee to do the best, coming in just over 4% year over year. Whereas the cities on the flip side, on the lower end of what they're expecting, actually price declines. They're looking at those cities closer to the Gulf, those cities where they've seen a huge increase in supply. Properties are just sitting, having insurance issues. And on the flip side of this list, Zillow is expecting the lowest price growth actually declines in cities that are located in the Southeast for the most part. Those located in cities like New Orleans, Baton Rouge, where inventory has been growing. Homes have been sitting on the market longer. They've had insurance costs rise. Got a lot of things happening in those markets that's causing homes to sit, causing inventory to build. And with demand lower and inventory building, that means a slower housing market. And also on that list, you have Austin, Texas, which they're expecting a 2.7% decline year over year. Now, remember, Austin was one of those markets that did really, really well during the pandemic because a lot of people were moving there, able to work from home, and it was one of the cities that shot up the most with home appreciation. But it's natural to see some of that pullback when it comes to growth because of how much growth they saw in such a short period of time. Now, going back to housing affordability, one of the major things that can actually improve affordability is mortgage rates coming down. And as we discussed earlier in the video, we've actually seen mortgage rates come down from somewhere in the low 7% range back in April to now sitting under 6.5% on a 30-year fixed mortgage. And a lot of people out there are wondering what actually happens to mortgage rates if and when the Fed starts to cut rates. This past Friday, Fed Chair Jerome Powell actually came out and laid the groundwork for interest rate cuts coming in September. Now, he did decline to talk about exact indications on timing and extent, but he did say the time has come for policy to adjust, indicating that interest rates are coming. Now, there's this belief out there that when the Fed cuts the Fed funds rate, that mortgage rates are also going to go down. I want to be very, very clear. I don't think that's going to happen. And the reason I don't think that's going to happen, at least in September, is because I believe that's already baked into the cake, if you will. As of today, interest rate traders are already predicting a 64% chance that the Fed's going to cut at least 25 basis points, with the other 36% expecting a 50 basis point cut. So there's already a 100% probability that the market is expecting at least a 25 basis point cut, which tells me that the market has already traded on that news. That's why we've seen the 10-year improve so much, because the market knows that the Fed is about to pivot in their stance. And as we know, the Fed has a dual mandate, which is price stability and maximum employment. And because inflation has come down so much, the Fed is no longer paying so much attention to inflation. They're rather now focusing on employment. And with unemployment sitting at 4.3% and rising, on top of getting US job growth revisions showing that we're down the most since 2009, it's giving the Fed full authority to be less restrictive, which essentially means you're going to see the Fed funds rate come down, which in turn is going to improve the spread between the 10-year and the 30-year fix, and mortgage rates are going to continue to come down. But here's the thing, it's not all going to happen in one day. It's going to take time. It's going to be a slow grind lower unless we see some major miss when it comes to the employment numbers. But with that, it's going to increase some buyer demand. So you are going to get more buyers out there in the market as mortgage rates move lower. But on the flip side, I don't think you're going to get the craziness that we saw a couple years ago if mortgage rates come down. And that's because housing affordability isn't going to improve substantially. Yes, it's going to improve, but not to a point where it's going to pull a bunch of demand forward like we had a couple of years ago. So with that, the housing market is likely to continue moving sideways, if you will. You might see a little bit of home price growth. You might see some declines in some markets out there, but I don't think you're going to see a major move in either direction. So if you're somebody sitting on the sidelines at the moment wondering, should you buy now or wait? My question to everyone pondering that question is, what are you waiting for? In fact, I'd love to know. Do me a favor and let me know in the comments of the video. If you're somebody sitting on the sidelines, what are you actually waiting for? And on the flip side, if you're actually buying in the market right now, Why are you buying versus waiting? I'm always curious to know what my viewers are watching, so do me a favor and let me know in the comments. Now, the last thing I want to say is because the housing market is shifting a bit, you're going to see some craziness out there when it comes to headlines. You're going to see some craziness out there with YouTubers filming videos, talking about crashes and all that crazy stuff. In fact, the data out there is showing more price stability in the market than anything else. So do me a favor, if you're considering buying a house and you're one of those people that watch a lot of videos online, just do your research. Make sure you know who you're watching and that they actually have a track record of success.